Hello and welcome back to Katie's Business Tips. Glad to be with you. Michael Lapede here, talking to you just in a short bit of videos about your family trust. And we're going to talk about assets going into a trust. Now, when you set up a trust, you want to know how to get stuff in there. I mean, you're going to have the settler who sets it up with a small amount of something, but what about my company shares? What about my real estate? What about my investments, right? How do we get stuff in the trust? When we want to get in the trust, we have a few ways to do it, okay? And these are the four main ways that you can do it. Number one is you can lend money to the trust to acquire the asset. Now that has to be interest. You have to pay interest on that once a year. It has to be paid, otherwise there's what's called attribution. It's for another video. Secondly is you may be able to gift it in, or certain ways to transfer it in. So certain situations may be eligible for gifting, but that's not always recommended. However, it is good in some areas. You can also just straight sell. If the trust has money, you can just sell and say, okay, here, I'll take the money back, right? And the trust will just buy whatever it is, whatever investment or whatever. And the last one is you can, of course, if it owns shares in other companies, the trust owns shares in your corporation, for example, you could flow dividends up to the trust to get the money in there too as well. So that's another way to get assets in there. So you can lend money, you may be able to gift, you may be able to sell, or you may be able to get income from what it owns going into the trust. Those are the four main ways you're going to get cash flow in money into the trust. And each are going to be dealt with, of course, different for tax purposes. Now, if you lend to a trust, obviously you may be able to, lend money to it or whatever the case may be, but you're going to take back typically a promissory note with prescribed interest rate. And right now that's still very low. We always got to keep track of when you do the loan. It has to be the prescribed interest rate at that time for the loan. And you have to pay that interest within 30 days of the year end. So you got to make sure there's enough money in the trust to pay that, so that's part of your planning. If we gift to a trust, right, we got to make sure that it's after-tax dollars, because let's say, for example, you own a property and you go, I'm going to gift it to the trust. Well, you first of all have to deal with the fact that you're disposing of it. That means there's a capital gain potentially when you put it into the trust, because it doesn't matter if you give it or sell it, you're disposing of it, and there could be a capital gain. Now, gifting to a trust can be used if there's no gain, of course, but we got to be careful, because gifting to a trust, if it's by someone that's connected to the trust, can occur attribution. That's what's getting to it. It doesn't always work to gift it. If it's outside and someone's not connected to the trust, it works very well. But if it's you as the trustee going, I'm going to gift my trust something, or I'm a beneficiary, I'm just going to, there's attribution, which just means it's attributable back to you. Another video. And the third one is selling to the trust, as we talked about. So you may sell assets to the trust, but it must be done, if it's your assets and you're selling, at fair market value. Whenever you're doing something what we call non-arm's length, right? That means you're connected. It has to be at what the fair market value is, and fair market value is what you could sell it for today on the market. Okay? If it's non-arm's length, if they're not connected, you're not related in any way, no relation through corporations, individuals, bloodline, anything like that, then most likely it's not a big deal. You can do whatever price you want. Now, when you accept, when you buy stuff from the trust, maybe you take back cash, maybe you take back shares. We could always have a combination of things. It doesn't have to be just straight cash for asset, right? So there's ways to get around that too as well. But when you're selling to a trust, always seek professional advice. This is not something that's always just that easy. And the last one is income from business and investments. Obviously, this can be from your own business. It can be from real estate or other investments that are producing cash flow that's going into the trust, right? And it can be dividends, capital gains, it can be interest income, pension income, other forms of income. It really doesn't matter. It's just a source of income that's coming into the trust. Now, when the trust receives it, the trust can retain it and pay tax on it, or it can flow through to the beneficiaries, and the beneficiaries pay the tax on their personal taxes. We have a choice when that income comes in, okay? If you have any questions, I know this is a very complex topic and we're just going through some very surface stuff here, but it gives you a good idea to allow you to dig in more and ask questions. We'd love to hear from you. Please post in the comments below, and we'll look forward to seeing you in our next Business Tips video.